Thinking about investing but feeling overwhelmed? Don't sweat it. In this video, we'll explore cash flow investing, a strategy that offers more predictable and consistent returns. Plus, we'll compare it with capital gains investing to help you decide which strategy is right for you. I'm Gregory Rozdiba, the CEO of Dundas Life. We're an online life insurance brokerage proudly based in Canada and committed to helping individuals like you navigate the complex world of insurance and investing. Want to learn more? Click the link in the description below to talk to an advisor. Today we'll cover the difference between investing for cash flow and capital gains. We'll break down these concepts and focus on how investing for cash flow can provide you with a sustainable pathway to wealth. Before we get into details, let's clarify what we mean by capital gains and cash flow. As investors, these are fundamental concepts you'll encounter regularly. So what exactly are capital gains? It's the profit you make when you sell an investment for more than what you bought it for. In real estate, investors who flip houses are investing for capital gains. Picture this scenario. You're an investor who purchases a rundown yet promising property in an up-and-coming neighborhood for $200,000. You spend another $50,000 renovating it to increase its market value. Now your total investment in the property is $250,000. A year later, the neighborhood has boomed. The property values go up and you decide to sell the house, and you manage to do so for a cool $350,000. This is where the concept of capital gain kicks in. The capital gain on your investment is calculated by subtracting the original purchase price and the cost of improvements from the selling price. So, in our example, you'd subtract your total cost of $250,000, which is the purchase price plus the renovation cost, from the selling price of $350,000, leaving you with a capital gain of $100,000. Beyond the obvious risks, capital gains aren't just a one-way street to making profit. There's a toll booth along the way, and it's called the capital gains tax. You see, the government views your profit from selling an asset at a higher price as income. And like all income, it's subject to tax. This is where things get a little tricky. Let's revisit the example we discussed earlier. You made a capital gain of $100,000 from selling a renovated property. Now you might be thinking, great, I have $100,000 in profit, but what about taxes? In Canada, we have a 50% inclusion rate for capital gains. It means only 50% of your capital gain is considered taxable income. So in our example, out of the $100,000 gain, $50,000 will be added to your taxable income for the year. Suppose you're already in a high income tax bracket, let's say 33%. That $50,000 might be subject to tax at that rate, which would equate to $16,500 going to taxes. Suddenly, your $100,000 gain becomes $83,500 after taxes. The takeaway here is that while making capital gains can be lucrative, it's important to factor in the impact of taxes. They can significantly eat into your returns and turn what looks like a great deal into a less profitable venture. Now let's move on to cash flow investing. Unlike capital gains, cash flow investing is about generating consistent income from your investment. Think of it like earning a steady paycheck. Using real estate as an example, suppose you bought a house for $100,000, spent $50,000 on renovations, and decided to rent it out for $3,000 a month. Now you have an annual income of $36,000. Assuming your expenses equal $1,000 per month, then you are generating $24,000 in annual recurring cash flow. Not to mention your property will continue to increase in value over time. So what exactly is cash flow? Cash flow is the movement of money in and out of a business or asset. It consists of inflows, which is money coming in from sources like sales, revenues on investments, or wages. And outflows, which is money going out for things like expenses, loan repayments, and investments. If the cash inflows exceed the outflows, you experience positive cash flow, which means there's money left over after covering all your expenses. On the flip side, if cash outflow is more than the inflow, it results in negative cash flow, implying potential financial instability. The benefits of cash flow. Well, for one, predictability of income. One of the most significant advantages of investing for cash flow is having predictable income. It's nice to have a reliable paycheck landing in your bank account every month. Consistent cash flow income comes from rental properties, dividends from stocks, or interest on bonds. It's much easier to plan your finances when you know how much money you'll be receiving each month. Stability to your overall financial picture also plays a pretty big role. Another key benefit of cash flow investing is the stability it provides. Unlike capital gains where profit is hypothetical until the asset is sold, cash flow is a tangible income stream that you can count on. It's there, rain or shine, regardless of what happens in the broader market. This steady income can help cushion the impact of any market downturn, providing you with a safety net in volatile times. It also offers more consistent return on investment over time, as opposed to peaks and valleys that can come with capital gains investing in things like a stock market. Last but certainly not least, cash flow investments often have more favorable tax implications. For example, rental income is taxed differently from employment income in many jurisdictions, with various deductions and allowances reducing your taxable income. What's more, some forms of cash flow, such as dividends from Canadian corporations, are given preferential tax treatment. In contrast, capital gains are typically taxed as soon as the asset is sold and the gain is realized, which can lead to a substantial tax bill in the year of the sale. Capital gains and cash flow represent two fundamental aspects of investing in real estate or financial assets. Capital gains refer to the profit made when selling an asset for a higher price than was originally paid for it. It's a one-time realized gain that occurs when an asset's value appreciates over time. On the other hand, cash flow involves the income generated from an investment over a period, usually in the form of rental income or dividends from stocks. Cash flow provides a consistent stream of revenue that can be used for ongoing expenses or reinvestment. To illustrate the differences between capital gains and cash flow, let's consider some real-world examples. We'll take similar properties and analyze them, both from a capital gains standpoint and a cash flow standpoint. Case study 1, investment property for capital gains. John Doe buys a single-family home in a gentrifying neighborhood in Toronto for $900,000. He thought the property was undervalued and hoped that the neighborhood's up-and-coming status would significantly increase the home's value. He invested another $100,000 in repairs and renovated over 2 years, targeting a higher-end market. After 3 years, John sold the property for $1.25 million. Subtracting the initial purchase price and the cost of renovations, he made a capital gain of $250,000. However, during the holding period, he had to bear all the costs, including the mortgage, property taxes, insurance, and maintenance. Additionally, once he sold the property, John incurred substantial capital gains tax. He also had to pay 5% of the property value, or $62,500, to a realtor as part of the sale. These costs considerably reduced his net capital gain. While the investment was profitable, it included risks like property market fluctuations, renovations cost overruns, and costs when selling the property. Case study number 2, property investment for cash flow. Jane Smith, on the other hand, purchases a multi-unit residential property in Montreal for $500,000. Her strategy was different from John's. She wanted to generate steady cash flow from the property by renting out the units. After additional renovations costing $50,000, she was able to rent out the units, generating a monthly income of $4,000. Unlike John, Jane didn't plan on selling her property after a few years. Her goal was to hold on to the property for as long as it kept generating a stable cash flow. Over 3 years, Jane made $144,000 in rental income. After deducting expenses such as mortgage, taxes, insurance, and maintenance, she still had a significant income left. What's more, Jane benefited from various tax deductions and allowances that reduced her taxable income. The predictable monthly rent checks provided financial stability and made it easier for Jane to plan her finances. Her property also went up in value in case she chose to sell in the future. Both investment strategies have their pros and cons. Investing for capital gains, as in John's case, can lead to a significant one-time payout, but comes with higher risk and volatility. It also requires a larger initial investment and is dependent on market conditions for a successful exit. On the other hand, investing for cash flow, like Jane, provides more predictable and stable income. It's a long-term strategy that allows investors to generate ongoing income from their investment. While it might not result in a substantial one-time payout, it offers financial stability and sometimes more favorable tax treatment. The choice between capital gains and cash flow depends on an investor's financial goals, risk tolerance, and investment horizon. While some may prefer the potential of large profits from capital gains, others might value the stability and predictability of cash flow. To summarize, both cash flow and capital gains come with their unique pros and cons. Each has its place in a well-rounded portfolio, but aligning your investment strategy with your personal financial goals and risk tolerance is a key to success. Speak with a Dundas Life investment advisor today to learn more about which savings and insurance strategy is right for you. And if you like this video, don't forget to like and subscribe to our channel. Thanks for watching.